What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my 3 stocks on sale series, this time for the month of June 2023. Now, in each episode, I pick 3 stocks that I believe are trading on significant discount right now for the long term, and I specifically choose one low risk, one medium risk, and one high risk option just for added variety. Now, with this month in particular, I'm actually going to take things a little further. Now, I'm not only picking 3 stocks here that are trading on gigantic crashes just on their own, but they're also trading significantly lower than even their pre-pandemic levels, which in my opinion, look, I know that the economy is really bad right now, high inflation, high interest rates, risk of recession, but in my opinion, these are stocks that are being held down by macro factors that are really weighing down on them. And once these headwinds are lifted, I do believe that these stocks have all the potential in the world to not only get back to their pre-pandemic levels, but even surpass that significantly as well. So these are the type of stocks that I like to be picking up during these type of environments that are being held down, that have potential to take off in the future. But let's not waste any time, guys. Let's just jump straight into my list here. Let me share with you the 3 stocks that I think are on sale right now. All right, and starting first here with our lowest risk option of the 3, I'm going with the medical device giant Medtronic, ticker symbol MDT, who is not only down around 40% from their highs, but the stock is also trading well below their pre-pandemic levels, which to me signals that Medtronic will rise much higher once the economy really starts to recover. Now, right now, of course, the macroeconomy is still struggling heavily, and when you combine that with all of the destruction caused by the pandemic, it's really the only reason why Medtronic is trading this low. It's not really anything wrong that they're doing specifically themselves, but in fact, the pandemic has not only sent a giant amount of hospitals into bankruptcy because nobody was going to them as they stayed home in fear of the pepperoni, but it also caused massive supply chain disruptions that directly impacted Medtronic, as they are, of course, the #1 market share leader of medical technology in the entire world, guys. So they're very large. Now, of course, you're going to see a struggle in their sales because of that massive size and their big footprint. I mean, not only is there super high inflation and rising interest rates right now that may be sending us into a recession soon, but that 1-2 punch of weak economy and supply chain issues basically caused demand to plummet for Medtronic's devices while also limiting the supply of anything that was actually in demand. Like, for example, this is a perfect example of this, really, was the numerous delays of their brand new surgical robotic system called Hugo. As a result, Medtronic's revenue growth actually turned negative in both fiscal 2020 and fiscal 2023. Rebounds have been seen in both cases, though, and I believe it's only a matter of time until the macro environment really improves, which should send not only their business rebounding, but also the stock price. In their most recent earnings report, Medtronic CEO noted that they finished the year stronger than previously anticipated and are now seeing most of their revenue headwinds start to dissipate, which should help them return to growth once again. For example, their biggest segment of all in cardiovascular saw a massive 12% increase in sales year over year. And while medical surgical saw one of the worst performances at a slight decline, that segment will probably be one of the highest growth in the future thanks to the surgical robotics market that is expected to grow at close to 20% per year through 2030. And even just medical devices alone is expecting over 5% growth as well. So at the very least, I think Medtronic can not only maintain mid-single digit growth, but maybe even surpass that with a few other growth catalysts working for them as well. One of which is their new valve replacement products for their structural heart business that is expected to have a growing addressable market from 5.5 billion today to over 7 billion in the next 3 years and reach 10 billion in the next 5 years. The business grew 11% in the quarter despite many healthcare staffing issues too, and a pepperoni resurgence in Japan. On top of that, Medtronic has huge growth opportunities in emerging markets globally, which they grew their sales on by a double-digit rate last quarter as opposed to just 2% growth in the US. And they're even ramping up Hugo around the world now too, with another 5 new countries added last quarter, bringing the total footprint up to 4 different continents. And so The reason why I'm buying Medtronic myself is very simple. This is a beaten down market leader with one of the best dividends out there that has not only been increased for more than 4.5 decades in a row, but has now risen to the highest yield that I've ever seen in the stock at about 3.4%, which is not only double the size of the sector and the S&P 500 averages, but it's also well above their own 20-year average of around 2% as well. Meanwhile, though, the stock is trading around 16% cheaper than the sector on a forward PE basis. So, to think that a world leader like this, with their strong reputation, is going to stay this low at these levels, I just don't think that's realistic long term. I do see a rebound happening with Medtronic over the long term, and I think it'll provide gains from not just the stock price, but also that really attractive dividend as well. All right, now moving on to stock number 2, that'll be our medium risk option. And this month, I'm going with an even bigger dividend payer, really a dividend beast here, and that is the telecommunications giant Verizon, ticker symbol VZ, who, just like Medtronic, is also down huge right now. In fact, ever since the pandemic, even with how important cell phone and internet usage has become throughout all the lockdowns and everything else, well, Verizon has actually fallen in every single year, with a 4% drop in 2020, 12% drop in 2021, massive 24% crash in 2022, and another roughly 12% drop so far this year as well. And from the top, this has now been a crash of almost half their entire value, leaving them at literally the lowest prices in over a decade for Verizon, with a dividend that has now risen to just about the highest level that I've ever seen at about a 7.5% yield, which is just gigantic of a dividend. I'm pretty sure it's the biggest of any of their direct competitors, but it's also more than double the size of both the S&P 500 and the sector averages, and still well above any of their own historical averages too. And their 18-year track record of growing that dividend is also the highest now in the entire US telecom sector too. So it's very impressive. Plus, the valuation has now sunk down to a level where it's around 60% cheaper than the sector on a PE basis. And so we have to ask the question, is Verizon's business completely falling apart to where a stock should be trading this low and crashing this hard and yielding such a big dividend and trading at such a cheap valuation? Well, I would say no. I mean, it hasn't been experiencing much of any growth, but over the recent years, it's at least been consistently flat on both the top and bottom line, whereas I've seen many other companies have significant declines in this deteriorating economy. And especially if we look at pre-pandemic levels, their sales and profits have actually grown since then by around $5 billion and $2 billion respectively. Yet the stock has actually crashed and lost almost half its value. That doesn't really make a whole lot of sense to me, especially given the horrible economy, because you would think that a more resilient business like this would be rewarded for that resiliency, given that, the use of wireless smartphones and the internet have basically become just as essential as water for most people's everyday life these days. But don't get me wrong, I do understand that they do have several other concerns, like the business not really growing much and even having areas of decline, like in their legacy pay TV business that they're trying to transition away from as more people continue to cut the cord in favor of online streaming services. But even here, we've seen many of the effects, the negative effects, really be offset by actual growth in other areas like broadband and Fios, where they added over 400,000 more customers last quarter, which, by the way, was the highest growth that they've seen in over a decade. And cash flows still came in much higher than the previous year, more than doubling their free cash flow year over year. Now, the concern is that it's still not enough to cover their huge dividend. Operating cash flow certainly is, but not the free cash flow, and that's mostly because of the gigantic capital expenditures that they've been making recently. Out of the $8.3 billion of operating cash flow, which is super high, a whopping $6 billion went straight to CapEx, leaving only $2.3 in free cash flow, which is just a little shy of the 2.7 billion that they spent on the dividend. So it's not very sustainable there. But in my opinion, these were more so temporary setbacks that needed to happen in order to maintain their competitive advantages. Verizon has been outspending most of the competition on not just fiber internet, but also their highly praised C-band expansion of 5G, which is one of the reasons why they always win the highest quality awards for literally decades and decades in a row. The thing about Verizon, the reason why I consider it to still be risky, is because the dividend is not very sustainable at the current rate of spending, which is massively high. It's been very high. However, I feel that that spending was necessary to build out their infrastructure, to maintain their competitive advantage, and to maintain their high quality, which I do feel will benefit them over the long term. This is a high barrier to entry in the market, and I feel that Verizon really sits on top. That's my opinion. And so the investments were necessary, but I think the high spending will slowly dissipate over time, and I think it can balance out with their very strong cash flows and even some added growth from certain areas, especially 5G. I think it'll take time, but slowly people will upgrade their phones and plans to benefit from those 5G technologies, and especially if the economy starts to recover. So I think you'll see Verizon spending less. I think you'll see their financials improve, and I think that balances out and the dividend becomes sustainable once again. That's my opinion. I've been right about this sometimes. I've been wrong about this sometimes. So take it for what you will. But my opinion is that they're not going to cut the dividend. Now, if they cut the dividend, all bets are off. The stock crash is warranted. It's probably a stock to avoid. But if the dividend does not get cut, this is like once in a decade buying opportunity here. The valuation is extremely cheap. The dividend is ridiculously high. There is no way that the stock can keep trading at these levels if the dividend does not get cut and the economy improves. The stock has to go up. And so I just see this as a very, very worth it kind of, it's a little bit of a gamble, but I just think it's so worth it, just in my opinion. But it is a stock that I'm investing in. Let me know what you think down below. But let's move on to the last stock. All right, guys, coming in here as the final stock of the list, the highest risk option this month, I'm going with a stock that has also seen a gigantic crash, but it's not even comparable to the other two. This is like on another planet, having now lost over 90% of its entire value over just the past couple years. And that stock is going to be the telemedicine giant Teladoc Health, ticker symbol TDOC, who had actually seen a huge spike during the pandemic up to over $300 a share, but has since crashed by around 93%, leaving it at just the low $20 range today. What a massive crash that's been. And so, was this justified too? Well, some of it was and some of it wasn't. See, sales have actually still been growing throughout all of these past years. However, that growth has dramatically slowed down, falling from around 100% growth during the pandemic down to less than 20% growth in 2022, and now just in the single digits going forward. Here's a better illustration of that on this chart here to show you just how dramatic the crash has been in terms of their growth. And just as important is that they continue to lose money on the bottom line, which those losses took a dramatic turn for the worse last year when they fell by a staggering $13 billion, and that really shocked investors. However, it should be noted that those losses were due to goodwill impairment charges, which are basically an accounting record on the balance sheet. It's when you acquire a company, but you feel that the value is actually a lot less than you previously thought. And this one comes from the $18 billion acquisition of Livongo that has unfortunately not been as successful as they had previously hoped. And speaking to the loss, CFO Mala Murphy specifically stated that the charge reflects the weaker macro economy and their slower growth plans because of it, but it doesn't actually impact their financial position or affect their ability to invest in the business going forward. Still, because of the continued losses, especially of net income, Teladoc has lowered guidance, laid off 6% of its workforce, and lowered their geographic footprint in an effort to cut costs and focus more heavily on profitability and their margins. However, Wall Street's reaction to this has mostly been negative because they want to see the high-flying growth immediately return. But in my opinion, that's just not realistic, and they need to be more patient as the growth will return over time. As the new moves by Teladoc are a way of setting more realistic goals for the maturing business that is already getting very large and needs to focus more heavily on profitability, especially given the horrible environment. We already talked earlier in this video about how much the medical market is struggling. Well, according to Fair Health, there was a gigantic 76% drop in the use of telehealth from 2020 to 2021. So clearly, coming off of the pandemic, the telehealth market has slowed dramatically and is thus affecting Teladoc, who happens to be one of the biggest market leaders of it. However, I still think that there's massive future potential here that will return to Teladoc's business and the stock. Through 2027, the telehealth market, for example, is expected to grow at over 25% per year, reaching close to $400 billion. Well, Teladoc only did around $2 billion in sales last year, so that's close to 200 times smaller than the addressable market. So I believe it's only a matter of time until Teladoc starts growing quite a bit higher once again. I really don't think that telemedicine is a fad that will ever go away. It's so much more convenient and saves both the doctors and the patients so much time, and it can even be much more affordable many times too. So it's just clearly the future of medicine. And while profits are weak right now, it should be noted much of Teladoc's losses are stock-based compensations that will dissipate over time as well. In fact, their operating cash flow and free cash flow have both turned positive ever since the pandemic, and that's an encouraging sign. And while the stock remains very high risk at a price to sales ratio of less than 1.5, which is over 60% cheaper than the sector and over 85% cheaper than their own 5-year average, I just think the gamble is worth it. Now, it should be noted that Teladoc is one of my smallest speculative stocks in my portfolio at less than 1%, but I am actually looking to build this position out, grow it larger over time, and make it quite a bit bigger. I would just like to see some things improve, especially their financials, but I feel that telemedicine is the future and I want to own one of the biggest players in that market. I think they have a huge amount of potential. They really just need the macro environment to be supporting them. And once that happens, I think the stock can fly once again. Again, it's high risk, but it is one that I'm willing to gamble on. But that's just my opinion. So let me know what you all think down below in the comment section. Do you like any of these stocks? What stocks are you buying? Let me know because I may feature them in a future video of some kind. And I hope you enjoyed the video. If you want to support the channel, hit that like button, subscribe. And if you want to join us on our community Discord, Discord, it's a lot of fun. You can sign up on Patreon. Link is down in the description. It really helps keep this channel alive, and I appreciate all that support. But I will catch you in the next video, my friends. Thank you so much. Take care, everybody. Bye-bye.